I currently think the US market is in major trouble. By market, I mean the real estate market and the stock market. In this video, I'm going to be discussing exactly why I think we're kind of heading towards a pretty aggressive recession and stock market crash, and what you should be doing to prepare for these sort of situations. I'm going to highlight exactly what I'm seeing and what indicators I'm getting that things may not be so good, as well as what I've been doing over the years to prepare for these sort of situations. Now, on this channel, I talk about global living and also try to coach entrepreneurs on how to approach the healthcare business as well as investing in real estate, because ultimately I want to be able to go out there and help people live their dreams by being able to provide for themselves financially as they pursue living anywhere in the world. If this is the sort of content that you find interesting and that you want more of, make sure that you like, subscribe, and share this video with anybody who shares your interest. My name is Carl Pierre, and this is ENTP Life. So in order for me to give you some background on why I think things are looking pretty sketchy, it's important for me to tell you exactly what my professional history has been and where I'm sort of drawing this information from. I'm fortunate enough to have gotten my entrepreneurial start at the tender age of 14, working in my family business, which was a healthcare staffing firm. Now that business started in 1996, and I got to see something quite unique over my professional career. I got to see two recessions take place and see exactly what leads to those recessions and what happens before and after, so that I've kind of developed this skill or this sense for what's happening in the market. Now, the first time that I ever seen a market crash was when the dot-com bubble burst right around 2000, 2001, and going into 2002. That was pretty much the recessionary cycle. It all lined up with 9/11. It lined up with the bloating of the stock market due to tech stocks. And what happened for our company was that things just kind of softened a bit. We weren't able to get any kind of business loans. The overall temperature amongst people was a little more reserved. Spending kind of got pulled back. But since we were in the healthcare business, we weren't affected so much. And I remember my mother talking about, oh, we're in a recession. And it became kind of like a catchphrase where people were conscious that there was an economic downturn. And with that came reduction in spending and the reduction of taking on risk. But again, at that point, I was pretty young. I was only 18, 19, pretty broke. Whether there was a recession or not, my financial situation was just the same. I was more concerned with going to parties on the weekend than really what sort of impact was this having on our business. For the most part, since we were in healthcare, things stayed pretty flat and actually grew because healthcare is one of those recession-resistant industries. I wouldn't say it's entirely recession-proof, because once there is kind of this pullback or retraction on spending, it's always going to limit growth potential. However, that growth potential is just limited. It's not completely turned down. It doesn't completely die. At the end of the day, people still need their care. People still need to stay healthy. And the government tends to kind of support that staple of our overall industrial complex. But some of the warning signs prior to the dot-com bubble bursting was the fact that every single person, college students, taxi drivers, people who knew nothing about investing, were investing in the stock market and making money. Essentially, they were just throwing money at the market, picking any company. It got to the point where if a company was launching a website, they just got their .com, that company would skyrocket. We're talking about 50, 60% gains in one day just because they registered a website. That's how insane the market was. And because of that, you had a lot of people refinancing their homes, a lot of money moving through the markets, whether it was private markets, retail banking. There was just a lot of liquidity. Getting a credit card was super simple. College students were able to just get a credit card in the Student Activity Center, get a cash advance on that credit card, turn around, push that money into a Scottrade account. That was one of the trading platforms back in the day, Scottrade. You were able to put your money in a Scottrade account, start trading the market, and potentially double and triple your money without really being that competent in how to invest. And this was kind of rampant throughout the entire financial system. But when the market fell apart and the Twin Towers came down, everybody that was investing in this way got hurt, and most people didn't recover. A lot of those dot-com companies that got heavy VC funding, heavy private equity funding because they had a website, blew up. Tons of them tons and tons and tons and tons of these companies blew up. And you could see that if you ever look up articles or histories or anything along the lines of what happened during the dot-com bust. There were so many horror stories in that era, and it was clear that it was just too much money going into this new area, and because people were making money hand over fist, it was a frenzy. Another thing that happened in that time was that people started to say that you can't miss, and that the market's just going to keep going up, things are great, and this becomes the rhetoric of the unsophisticated investor. Because the sophisticated investor knows that no market can continue to go upwards forever. That is the mindset of the amateur, where gains are outrageous, gains are the highest that they've ever been, and for some reason they think that this outrageous moment in time is going to last forever or for years to come. And the only reason they're hoping that is because they themselves are benefiting from it and want to continue benefiting from that. Now let's fast forward to recession number 2. This one I was a little more mature in. I already had graduated from college. I had my own nursing agency at the time, so I was more directly affected. I had real estate holdings. I was actively investing in more real estate. And that recession was the result of the collapse of the housing market and really the subprime lending crisis, as they referred to it. Essentially, in that time, real estate was getting a lot of favorable financial support, meaning a lot of the banks, private investors, all the rating agencies rated real estate investments from both the perspective of the investor and the perspective of the lender as being high quality. If you want a real entertaining video that covers this, just watch The Big Short, and they go over the subprime lending conditions, what led to the collapse in great detail, and it gives you a clear understanding of why that market collapsed. But before it collapsed, I noticed something quite interesting. 2 things happened. The first thing that I noticed was that the same rhetoric was out there. There were tons of seminars and radio broadcasts that were going over buying real estate, investing in real estate. The flip that house sort of shows were very popular. Everybody was making money hand over fist. People who were police officers were also real estate agents. Doctors were also real estate agents. Everybody was winning. Mortgage loan officers. These guys were pulling the most elaborate scams out there to rip money out of homes, to lend money to people who weren't qualified for it. And everybody was talking about how they're so successful in real estate. And then I noticed that this is a common trend before the collapse. Again, you have people who know nothing about the historical context of investing talking as if they're Warren Buffett. That's usually another red flag. But this second red flag is probably the one that matters the most and the one that I paid attention to. Right before the collapse, I was getting all kinds of loan offers, credit card offers in the mail, people emailing me, trying to lend me money, cold callers trying to lend me money. Every single place that I went was throwing money at me. And of course, I took it. I took the line of credits, I took the credit card limit increases, I took the business credit. It was coming like wildfire. And it didn't matter if it was credit for real estate or it was credit for personal expenses or business development and growth. But once the market started to collapse, something interesting happened. All of those credit lines that I had, all of the term loans, all of the money that was being offered to me, even applications that were in process, got denied, closed, retracted. The money was drying up. And at the same time, because the money was drying up, people that were dependent on floating their businesses with this money, and the people who were in the middle of real estate projects, all of them got screwed. And everybody, well, not everybody, most people were pretty cash poor. And since this liquidity got pulled back from the market and most people were cash poor, businesses had no choice but to kind of pull back on their growth plans, to stop projects midway. Real estate developers were in the same sort of situation. You had projects that were half funded, depending on a next draw or a secondary loan, and they couldn't get those loans. You had buildings that were completed, and all of a sudden, all of the creative loan products that would let people buy homes for 105% down, where people had put down just $2,000 to reserve their condominium, could no longer get financing. So these buildings that were 75%, 80% pre-sold because everybody was euphoric about buying real estate, they no longer had an end buyer because most of the people could no longer qualify for this debt. Now let's talk about something else which is rather interesting as well. Let's say that you're somebody who has $10,000 of credit card limits. I'm just using this as an example. And you were hanging out $5,000 or maybe even $4,000 of outstanding credit card balances. Now you would have a 40% to 100% utilization rate in that situation, right? You're using $4,000 out of $10,000, and that's considered favorable by the credit bureaus. But once the credit agencies start to pull your credit back and say, hey, you know what, we want to limit our exposure. We're starting to see that consumers are using their credit cards more and more because they are cash poor and they are still consuming, or they're using their credit to pay other debts or to maintain their person. Once they see that, they pull the limits back, almost all the way down to your loan balance or your outstanding balance. And when that happens, your debt to utilization ratio gets killed, right? So essentially the credit bureaus start to rate you even lower because the credit agencies have reduced your limits to protect themselves, and now your credit is jammed up. So not only did you have outstanding credit and now your credit is reduced because your utilization appears high, but if you were in line to get a loan or a mortgage and that happens to you, your credit gets shot, you might fall under the minimum requirements, and then you're no longer eligible to invest in that asset that you were looking to purchase. So what am I seeing today that mirrors all of these previous situations that I lived through? Well, what I'm seeing today is that the same sort of thing is repeating itself, especially when it comes to the lending and the group of people who are just euphoric about things continuing. If I go through my Instagram feed, you have a whole bunch of gurus talking about investing in the stock market, investing in Bitcoin, investing, grow your business, make tons of money. Here's my Lambo, you can do it too. Airbnb, it's the entire world is promoting how successful they have been. And in reality, the market has gone wild since the lows of 2009 and has gone even more crazy in the past 3 years. For this next scene, I'm going to have to take you over to my desktop so I could show you a chart of the S&P 500 to show you how similar market conditions are today to previous moments where the market crashed, what sort of decline we had, and why this is pretty freaking scary.
Okay, so here's my trading platform. And this is pretty much what I use to evaluate the general breadth of the market. Now, these are all the years that we have in recent history, dating back to about 92, 93 to present, okay? You see this boom here? This is the dot-com boom. The market was relatively strong, and we went from about 500 on the S&P to 1,500. We're talking about 300% growth in roughly 8 years. Let's call it 8 years. 300% growth. Okay. When the dot-com bubble burst back in around November of 1998, we started to see this decline, and we went from 1,500 or 1,600 all the way down to 800. There was a 50% reversion. The entire bubble pretty much got erased and wiped out. Then the housing market started to create this new bubble. And you can't necessarily call this all a bubble because this is kind of steady and consistent economic growth, but this was mostly fueled by the real estate market. And you see this moment here where over a year and a half, we got a significant amount of growth. That was bubble land for real estate. Now, in November of 2008, Obama was just getting elected. We had a changing of leadership, and the market at the same time was collapsing. And from the end of 2008 to March 2009, again, we saw a complete reversion, wiping out this entire 6-year period of an uptrend, completely wiped out in a year and a half, completely gone, erased. All this growth erased in a year and a half. Now that's important because what you'll always notice is that when markets are collapsing, they collapse a lot faster than they've gone up. Here we had years of prosperity, and in a year and a half, that got erased. Now from 2009 till present, we've gone from 600 and let's just call it 700 on the S&P 500 to 4,800 from 2009 to the peak in 2021. Guys, that is a 600%. 600% increase in the market. From the lows of 2009 to 4,800, we're talking about 6 to 7 time increase in the market. That's insanity. Okay. We've never seen anything like that in any other cycle. Now, all of our assets got nice and bloated. Our 401ks, nice and fat. Our holdings in real estate, the values went up. I was buying in all this time here, and it was hard to get loans. It was hard to get your hands on cash. Nobody was interested. So I have assets that I purchased back here that also benefited from all this growth. And now we're in a moment of the reaping, right? It's got to be harvested at some point. And this is what we're looking at. This moment was the COVID collapse. Okay. If you look at it, it corresponds March 2020. Okay. March 2020 was that time. February and March, the market collapsed from its highs of 3,400 to 2,200. It's about a third wiped out in 3 months. Okay. Now that is after this huge market run. This was, if it wasn't for the pandemic, this was due. A nice, healthy correction. There was one correction here that's fairly healthy. But look, this was previous resistance. 1,500 was a huge level. We finally got over it. The sensible retraction should have been somewhere in this time period, back down to about this 1,600 level. That would have been healthy. And then another market cycle to continue. But because of economic policy, because of growth in China, the overall economy being pretty good, things kind of went unchecked. Now, the market got frazzled during this downturn. Completely shocked, completely scared with what was going on. And I've never seen anything like that. In my entire life, I've never seen everything come to a stop. The airlines not flying, people not traveling internationally. The world came to a stop. And all we saw was a 33% decline in the market. That's kind of insane. So what happened at this point to set the floor, very similar to what happened at this point to set the floor, was that the government came in and bailed us out. They printed money. They printed money in 2009 to get the economy going again. And when they printed the money, they put it into the hands of the banks to buy out all their bad debt. Okay. And of course, what did the banks do? They hoarded that cash, reinvested in the markets at record low prices, and they made all the money, right? And multiple exit events along the way, taking profits along the way, etc. So this was a beautiful time. Now, in the recent pandemic, when this collapse happened, what was the government solution again? The government solution was to put money into the market. Except instead of putting it into the hands of banks, they put it into the hands of all businesses, including myself. They rolled out the PPP loans. They gave tons and tons of aid to companies, big and small. And that money went into the hands of people who understand capitalism. And at the same time, they slashed interest rates to near zero, making borrowing money super cheap. So they gave us a bunch of free money. And then after giving us a bunch of free money, they made money to borrow almost free and readily available. So if I have this newfound surplus of cash and I have the ability to borrow at damn near zero interest rates, what am I going to do? I'm going to buy more assets, especially assets that perform at greater than 0%. If I buy something that performs at 4%, 5%, and I'm paying 0%, why not? Right? I'm going to make a 5% spread off of all the money that I borrow. And then if you gave me a bunch of free cash that I don't have to pay back, that can be forgiven as long as I employ people, then I'm going to employ a bunch of people in sales and business development so I could grow my business a bit. But this money went into the hands of a bunch of more or less sophisticated people. These are the business owners, corporations, etc., me included. So with assets on sale, with money super cheap, that money found its way circulating back through the market in a very unnatural way. And from the lows of March 2020 to the highs that were established right at the end of 21 and in the beginning of 22, we saw the market go from 2,257 to 4,800. The market doubled in value in just about a year and a half. That's an unnatural thing, especially when you're looking at this chart. The market, this growth here is unusual. Look at how much the market has grown in this last era compared to the last 30 years. Look at how flat the growth was. This is normal, progressive growth. This is bubble land, crash, bubble land, crash. And this is just pure insanity. Especially coming out of a time period where the entire world froze up. You still have markets throughout, you have China that is in terrible shape, still dealing with COVID after effects, lockdowns all the time. It's absolutely crazy what's going on. So to think that as the market corrects itself, as economies contract, that we're not going to see a complete erasure of all the money that was artificially pumped into the market, especially with the government having no choice but to raise interest rates and the government having to cut spending and businesses having to cut spending because guess what? They overspent because they gave them a bunch of money to keep staff that they would have normally fired. What do you think is going to happen? There's going to be layoffs. There's going to be cash out events where investors like me are going to be selling their assets to get real cash back. All these things are going to put pressure on the market, and we've already seen it for the most part this year. But this is only the tip of the iceberg. This is just the beginning, erasing just the pandemic years, and we're probably going to give back some of the regular growth years that should have been given back in a normal, healthy correction. Overall, my projection on where the market is going is back down to about 2,200 in the next 15 months. And the reason for that is, again, if you look at the length of time that it takes for markets to correct, the market lost a third of its value due to the pandemic. That was kind of pure anxiety. It lost a third of its value in 3 months. And if we lose a third of our value from the highs here, that takes us down to 3,600, which we've already tested. That was a 25% correction. We tested 3,600. If it was a third, we'd be down to around the 3,000 mark. And when you look at this chart and you look at where things went to during the pandemic, it comes down to this 2,200, 2,300 area, which also coincides with where the market last kind of flatlined and established a new base. I really think we're headed back to 2,300, and it's not going to be easy for a lot of people. Just to be clear, I am pretty aggressively short in the market. I believe in my heart that unfortunately we're going to be going down a bit, and if I'm able to benefit from that, I am. I have a ton of put positions from now till December, and depending on how the market trades, I may be doubling down on that put position for slightly longer because I do believe that 2,300 is in the cards.